What are the forecasts? How have things changed in the last week based on technical and data analysis? And again, that's always what it's about, folks. It's about getting the best probabilities to understand the most likely outcome in the near term, but also in the long term. And as you guys know, I remain a huge long-term metals bull, especially on gold and silver, but that doesn't mean in the near term the prices are going to go up. So let's take a look at what we have here. Number one, we're looking at gold. You guys know my parallel here. This kind of gives us the worst case scenario for gold down here. Now, to the upside, again, eventually I think we're breaking out, right? In fact, if you understand technical analysis, and when you have a down sloping parallel, let me put that in for you guys right now. So if we have a down sloping parallel like this, price, I would say about 75 to 80% of the time, eventually breaks out. Okay, that's just the general probabilities that we always talk about in terms of understanding what the ultimate likely scenario is. But this is the kicker. Generally, it requires 3 hits of the bottom trend line. 1, 2, where's our next one? And that's what has me kind of a little bit on the fence here. As much as I love gold long term, and again, how can you not when you're looking at the fiat currency fiasco, the debt fiasco of countries like the United States, gold has to be a place where you feel more comfortable storing your money, your assets, if you will. But having said that, it does concern me still that we could make one more flush out, much like Bitcoin is doing, to come down and take a hit of this trend line. All right, now again, what's interesting about that trend line is that if we look at this zone right here, right, what do we see? We see a trend line amongst those high pivots right in here. And if we extend the parallel there, look at that, right down here. And so this puts it into July. So basically a month, little over a month out, that maybe in the next month, and wouldn't this be fantastic, right? Is that if we get in a scenario where in the next month we flush down here, absolutely you will see me buying gold in a major way. Because again, I want to be clear on this. Just because the chart may dump out in the near term due to fear, due to liquidations, due to other factors, it doesn't change the fundamental aspect of the trade. And I think that's what most people kind of get wrong, is that they're so focused on well, this is the thesis and it's still in play, so it'll go up. You're right. You're absolutely right. But it doesn't mean in the near term things can't occur that could cause a flush out. Now, the beauty of this chart setup is that we know if it fails, and it doesn't take much for it to fail. So let's say it doesn't go down there. How would we know? Let's go back to the charts and take a look. So again, whether or not we come down to the third hit, that's again the most likely scenario. But the beauty of this is if we break this trend line to the upside, then you have a breakout and we can start on our merry way to the upside. So again, based on where we currently are, it's really not that far away. We're currently trading around 4,500. We break 47, 4,800, game on to the upside. Now, a couple other things I'm watching here. Throw in your 50 moving average, all right, your daily 50 moving average. And I'm going to even get rid of this parallel for the time being. Let's just focus, even get rid of this. Let's just focus on the 50. Notice what the 50 is even telling us. The 50 moving average hits, and so far hasn't been able to break out. Now throw your 200 moving average on the chart. Hits. And look at how these two trend lines are converging, squeezing price. And what this tells us is, remember how I was just saying that if we do see a fall in gold, it'll kind of get down to that level, that 3,600 level here by July, sometime in July. Well, if we know wedge patterns, as wedge patterns work, price gets squeezed, but then when it breaks, it has a major move up or down. We're likely going to know the result of which direction gold is going by the end of July. Isn't that amazing? And again, you can really see in this chart, as I just clean it up a little bit, how the moving averages are even condensing and squeezing price more. So we can have the moving averages there, then we can throw back our parallel trend line here, right? Our parallel, there we go, my general rough parallel. And basically we now break the chart down to a point where if it breaks here, it's going here. If it breaks here, we probably go to all-time highs. If it breaks here, we're going to go down probably to this level right here. You see that? And so this is, as a technician, how we have a step-by-step, a play-by-play. Let's get into silver real quick here, guys. Taking a look at silver. If we bring up the silver chart, I'm going to get rid of the moving averages for the time being. We can always bring them back. Silver still, to me, looks bearish. Okay, why? Well, number one, you have this little mini head and shoulders, right? Shoulder, head, shoulder, okay? That at least tells us we're going down here. Number two, we had a move up and it fully got reversed. And then instead of bouncing back up, it's, what is this pattern? Bear flag. Well, that's another bearish pattern. All right, then we also had this trend line here and it's broken. And look at how when it broke, it tried to get back above and couldn't, right? All of those are giving us odds. Now, remember, that doesn't mean it's a guarantee. It just means the odds are probably 80% or more that this is going down at least to 66 to 64. All right. Now, eventually, do I think it's going to 50? I still think so. Again, if I'm wrong, so be it. I have my long-term gold holdings already. I would buy more 50 or sub 50, but no big deal. That's the beauty of it.
Believe it or not, and nobody wants to hear this, but it's a setup for both. It is, on the long-term chart, it's a very big bull flag. If gold finds stability here and starts to run higher, you got, if you're not in it, you got to get back in it, because the next target is about $8,600 per ounce. The short-term price action, using Fibonacci based on the most recent price action, this sell-off and this bounce, is pointing to 3,600, which brings it right back into this breakout point, which this is where that euphoric phase was, and price went parabolic. Everybody piled in. The markets are very efficient. Whoever kind of chases and drives price up for a euphoric phase, the market is going to try to shake them out. It's going to try to wait them out, meaning this market could take a year or two before gold and silver maybe stabilize and start to go higher. So the market's very efficient, and it is gunning for 3,600 for gold. So if the stock market starts to roll over, we have seen precious metals sell off with stocks. It's been the norm for most of the year. If the dollar breaks out and rallies as the stock market is falling, that is even more pressure on metals. So we could very easily see gold and silver go into a very precipitous sell-off. It's about a 20% haircut, but it'll bring it right back to where it was pre-parabolic spike, and it'll be an amazing opportunity. I mean, if it gets to those levels, I'll actually be looking to get back into physical metals. We sold gold at about 5,100. We sold gold at 111, which was right up near its peak. And I would love to be able to, accumulate it and reload at a value like that. So what's going on here, David, is this long-term moving average, this green line, the 150-day. A lot of people use the 200-day. It's very similar. The long-term trend is up, but the short-term moving averages in trends are down. And the price action is also pointing down. It's actually bearish price action. So we have a long-term supportive trend, but we have two negative short-term trends. And so we have a mixed signal, which is why we're not doing anything in the precious metals space. We just have to let this work itself out. If it starts to break down and sell off, I'm not looking to benefit from a falling price, but I am looking to pick it up when it does hit one of these critical technical levels, which will be a killer deal to pick up metals if it gets down to that price. So that's how I see gold. So we do that through a series of ways. I mean, we can look at this is the NASDAQ trade, but very similar as the S&P 500. The way you do that is to have rules in place, have a strategy, right? So when price starts to move up, you move your stops up, you slowly scale out as you hit certain thresholds, knowing the market eventually will have some type of reset and calibration that you could get back in again. Overall, you need a rules that when the market starts to pull back, you have to be able to identify, is this just a normal pullback within the uptrend? Or is there something underneath the hood of this market that is showing real signs of weakness? Is it actually starting to break down? And so that's kind of how we look at the market, through this lens over here. When we see deep red, that means the market is breaking down, it's weakening, it's bleeding liquidity, it's bleeding shares to the downside. And so we want to step aside. And so it really comes into just being, decisive and having rules and discipline to say, okay, the market's strong, we got to get back in. As we know, the market climbs a wall of worry, and who knows, it can go as high as it wants and keep going that direction. And so the same when it reverses. When it reverses, we've got these big profits and these big gains, but you do at some point have to get out and protect your capital, because you don't know if it's going to be a 3 or 5% correction or potentially like a 30 or 40% correction that takes years to recover. And so that's what we focus on is making sure that when the market rolls over, are we reanalyzing and saying, is this just a pullback or is this the start of something uglier and we should protect our capital? For sure. So when we look at the long-term trend, I mean, we've been in a bull market really since May of 2025, since this new bull market has taken off. It's had huge gains. You know, if you're looking at it from a bull bear market standpoint, you definitely need a lot of wiggle room. We use price action. We do set initial trailing stop for our long-term investments that trails about 20% under price. And as price starts to move up, it slowly just moves up as kind of like just a default. If there's some black swan event, there is something that will kick us out and protect our money. But overall, as a trader, short-term trader too, you do need to move your stops up, but it depends on the asset class you're trading. So for example, if we're trading the S&P 500, we may have a 5% stop underneath that, right? And let the market mature. And as we hit certain thresholds, we'll start to move that stop up. But if you're trading a sector that is much more volatile, or if you're trading an individual stock, they all have their own characteristics. So you can use basic analysis, look at the average true range of how much that asset class moves over a 5-day window, a 20-day window, depending on the time frame style you're trading, and say, okay, well, this thing on average moves 8.5%. So you probably need to put a stop in somewhere around that level. You don't want to put a stop smaller than that asset's average, wiggle room. And so that's how you have to do it. Every asset is a little bit different. In some cases, you need big ones. Other cases, you can use very small ones. So it really comes down to analyzing the asset class or the style of asset you're